Okay, 2017, question number 28. What is meant by the value of money? What does value of money mean? A good example is what I told you all yesterday. You know, your mother goes to the market, right? Earlier says with 1,000 rupees she could have bought these stuff, but now with 1,000 we can't even buy this. Look at how much I can buy, right? That is what you call the value of money. That 1,000 rupees was more worth or had more value, let's say 10 years ago compared to now. So what does that mean? What does value of money mean? Value of money, guys, or in other words, this is the purchasing power of money. With that amount of money, how much of goods and services you can buy. That is what you call the value of money. Okay. Some video is on. I don't see anything, but okay, right. I don't know. I pinned my video. Okay. So what happens if the value of money goes up? Mm, okay, right. Okay. So what happens, guys? What is sorry, not the value of money going up. What is the value of money? So value of money is the amount of goods and services that can be purchased with a given amount of money, right? That is what you call the value of money. How much of goods and services you can buy. Is that okay? Those are very direct questions, guys. Just asking the theory. It's not the amount of well stored, it's not the gold reserves, it's not the cost of production, not the opportunity cost. Hmm? Then number 29. Inflationary gap can be reduced by. Now, this question, guys, you don't have to think too much. Think how they can reduce inflation. Think of it in that angle. Now, inflationary gap is because when the aggregate demand is at a way higher level than the aggregate supply. Think of that, Will. How can you reduce the aggregate demand or how can you reduce inflation? Think which one. So, to reduce the inflation now, why is there inflation? There would have been inflation because the aggregate demand is high now. Because aggregate demand is greater than the aggregate supply. Or in other words, maybe the planned expenditure is greater than the planned output. That's why there is inflation. So they are asking you, how can you reduce this? So to reduce this, what should you do? To reduce this, you have to bring down the aggregate demand, or in other words, you have to bring down the aggregate expenditure. You have to bring it down. So tell me, how can you do that? Increase the government spending. Government spending is a direct component of aggregate demand. If you increase government spending, what happens? If you increase government spending, aggregate demand will go up, inflation would go up even. Not the solution. Increase the supply of money. If money supply goes up, again, aggregate demand goes up, right? There's so much of money in the economy, people start consuming, firms will invest, aggregate demand goes up. No, you can't bring that. Then increase in the income tax. That is the same question, no? What happens? When you increase the income tax, disposable income comes down. Disposable income comes down, consumption comes down. When consumption comes down, what happens? Aggregate demand comes down. Can be a solution to bring inflation down. Next one, decrease in the central bank discount rate. Yes, discount rate at your level, think as the interest rate. So if the central bank reduces interest rates, what's going to happen? If they reduce interest rate, money supply will go up, or aggregate demand will go up. People will spend, right? Firms will invest. So again, no. Then decrease in the SRR? No, right? If the SRR goes down, the commercial banks have more reserves with them to give out as loans. Reserves will increase, loans will increase, money supply increases, aggregate demand also thereby increase. So which one can be our answer then? Our answer that brings aggregate demand down, number 3, right? Fourth one, discount rate, guys, think of it as the interest rate at your level. We'll not go into discounting of all of this. At your level, think of this as the interest rate. So if the central bank reduces the interest rates, what's going to happen? If they reduce the interest rate, money supply will go up, no? Aggregate demand will also then go up. Yep. 29 is 3. Okay. Decrease aggregate demand, only the government. The government charging more taxes nowadays. Yes, one reason that the government charged high taxes last year was to reduce the aggregate demand. That is not the main reason. The main reason was to raise government revenue. To reduce aggregate demand only, they increased policy rates last year. They kept it at 15.5, 16.5 levels. That was to bring the aggregate demand down. Yeah. When interest rate low, investments would be low. No, when interest rates would be low, investments will be high, guys. Because when interest rates are low, firms can easily borrow and invest. They will easily take bank loans. They will do all of that, and they will now expand their factories. They will start a new branch. When we are talking about investment here, we are not talking about treasury bill, treasury bond, not those investments. We are talking about productive capital investments. Remember what we study under investment in GDP, long-term capital, that investment that is going to go up. So they are going to uh, start factories, buy buildings, right? Expand. That's going to happen. So when interest rate comes down, investment goes up. Clear? Any other question? 29. Fine. Okay. Then we'll go to 30. Okay. Look at this. What will be the probable effects of an increase in VAT on demand pull inflation and cost push inflation? Okay. We'll think of the demand side first. Yes. Recently, you would have seen a lot of companies are now charging VAT. Okay. So because a lot of companies are charging VAT, what happens to your consumption? Do you like to go and buy from these people? So many companies. Now, a good example I'll give you is Street Burger. That's the most relevant example I can think. Because the VAT threshold came down recently, now Street Burger is also charging VAT. Earlier they didn't charge VAT. Now they are getting caught for VAT and they are also charging. So now what happens? Now you know, because they are charging VAT, consumption comes down. So when now people don't like to buy from. So when consumption comes down, guys, what will happen to aggregate demand? Aggregate demand will come down. So when aggregate demand comes down, what happens to demand pull inflation? AD decreases, demand pull inflation now will decrease, no? Now, so demand pull inflation decrease. On the other side, think of the cost. When there is a VAT, right, or any sort of tax, what happens to the cost of production? Cost of production. Think of it in that side. What happens to the cost of production now? The cost of production goes up. No, now it's expensive because they have to pay a VAT and so much of stuff. So when that goes, what happens to aggregate supply? What happens to aggregate supply if the cost of production and all goes up? Aggregate supply will come down. So if aggregate supply comes down, what happens to cost push inflation? What happens to that? Cost push inflation will start to. This can be argued in so many different ways. I remember when I was, this is the A-level paper that I also did. I remember, I was thinking of this in so many different ways. Now, for example, you can say, so now, for example, if there is VAT, sir, prices are going to go up. Okay, so prices are going to go up. So then you can say, so there is demand pull inflation is going to go up. But that is the wrong way of thinking. Think of it as the component, which components are going to get affected and then work with it. So when there is a VAT, consumption will come down because people don't like to do it. Yes, cost push inflation increases. That's what I also said. Arrow is up. Okay. So yeah, we'll assume that this VAT is split, half for consumers, half for producers. Okay. So I'll re-explain this. Let's say there is a VAT that comes. Because of this VAT, let's say 50% consumer is bearing, 50% the producer is bearing. They don't put the whole thing on consumer, let's say. So then what happens? As consumers, do we like to buy from these fellows now? No. Consumption will come down because now it's expensive to buy from them, no? So when consumption comes down, aggregate demand comes down. Consumption is a part of aggregate demand. No? AD equals C plus I plus G. So aggregate demand comes down. When aggregate demand comes down, what happens to demand pull inflation? Demand pull inflation comes down. That is the first part that I explained. Then the second part. Now, if you take a firm, what happens? Because of a VAT, like let's say they are bearing half of that VAT, their cost of production goes up. So when cost of production goes up, what happens, guys? Their aggregate supply comes down. No? When cost of production increases, okay, think when there was aggregate demand and aggregate supply like this. Okay. So now what happened? Cost of production went up because of the VAT. So therefore, aggregate supply has come down now. So there is cost push inflation there, no? Here. Earlier the prices were here, but now because aggregate supply went down, there is cost push inflation. So cost push inflation goes up. So that can be the argument. Which one is the answer then? Decrease and increase can be number 1. Is that fine? Check. Questions, problems, issues? Again, guys, I'll agree with you. There is so many different other ways that you can argue this. But this is the most correct way of arguing it. Okay? 31. Easy one. Which of the following assets is most liquid? Now, they have not said assets for commercial bank. They are just saying assets. So, which of these assets is most liquid? That means you can easily convert it into cash. Savings deposits, treasury bills, demand deposits, treasury bonds, real estate. What is the most liquid? Come on, this is the easy one, guys. Even if you all know business studies, you all should be able to answer this. Give me an answer, others also. 1, 2, 3, I get around 20 answers. The other half of you all are missing. Hope you all have not fallen asleep. Which one, guys? Which one can be the most liquid? Can be demand deposits, right? Now, remember, they are not asking for most liquid for commercial banks, because if it's demand deposits is not an asset for commercial banks. Now, they have not mentioned the commercial banks. So, you are talking general as a person, okay? So, demand deposits are what you call your current accounts, where you can write checks and all. That's the most liquid, no? You can easily convert that into cash. What is the next most, guys? After demand deposits, what do you think? So this is the most liquid, number 1. After that, maybe savings deposits. After savings deposits, which might be the most liquid? Maybe treasury bills. After that, treasury bonds. And then finally, you will have real estate. For commercial banks, they can ask this guy because these are not assets for commercial banks. For commercial banks, their most liquid asset will be their reserves. Savings deposit is less liquid than demand deposit. Demand deposit, you can write checks itself and give. That is the most liquid. Savings is also equal liquid, but it's after demand deposit. Demand deposits is what we call bank money. No? It's already kind of in the form of money. You can write checks itself and give with that. So that's why we say demand deposit is the most. Savings is after that. Real estate, guys, are property. That's the least liquid. So real estate means property, and you know all of this. Okay. Now, then we'll go into 32. Okay. 32 says, suppose you deposit. Yes, savings deposits are part of Niyaman. Savings deposits, fixed deposits, treasury bills, commercial papers, all Niyaman. Okay. 32. Suppose you deposit 10,000. Suppose you deposit 10,000 in your deposit account in a commercial bank. If the bank wishes to hold 20,000 of all deposits on reserves, how much new deposits can it create as a direct result of your deposit? They are asking for your bank. Very simple, guys. Think, you come and deposit 10,000. You come to the bank and you deposit 10,000. When you deposit 10,000, the SRR is how much? SRR is 20%. So from this 10,000, they have to keep how much with them? They have to keep 2,000 with them as reserves. Reserves, they'll have to keep 2,000 with them. So the balance they can give out as loans, right? That's what they're asking. How much of a create as a, see how much new deposits it can it create as a direct result of your deposit. They can give that out as loans. Then the balance that fellow will go and put in another bank. A new deposit is created. So how much of new deposits can be directly created, guys, because of this? It's that balance 8,000. They are not asking how much of new deposits can be created in the banking system more. They are not asking any of that. They are simply asking, because you came and deposited 10,000, because of this, how much of new deposits can this bank create? They can give out that 8,000 as loans now after keeping 2,000. So that 8,000 will go as a new deposit to another bank. So that is your answer. Fine, guys. Are you all okay with that? Yep. Okay. So if it was for a banking system, then you can use the multiplier. If it was a banking system, if they ask because of your deposit, by how much will the total banking system's deposits increase by? If they ask something like that, then 20% is your this thing. Your money deposit multiplier is 5 times. So then when your 10,000 comes, it will get multiplied by 5. In the whole banking system, there will be 50,000 worth of deposits. If they ask for the whole banking system. But they are not asking that. No, they are asking because your 10,000 came, how much is a direct new deposit that can be created. Therefore, answer should be 8,000. Going to okay, in 28th question, the value of wealth stored in the form of money. Yeah, you can take that as near money. No, so my question is if they ask what is the amount of total deposits in the banking system, total deposit banking system will be 50. If they ask what are the amounts of new deposits, then you can say yes, 40. New deposits in the banking system because of your deposit, you can say 40. Okay. 11 and 12, no guys, I have not uploaded 11 and 12 on YouTube. I am waiting to upload the rest and then upload 11 and 12 because the YouTube videos, I have a number. So on the, if you would have seen each YouTube video just for you all to follow it easy so that you all don't get lost, I have added a number, right? On the thumbnail here, 131, 130. Can you see? So this is the order of videos you all have to watch in case people get lost. So I'm planning to, I design all of these one by one by one. So I'm planning to do the 7, 8, 9, 10 quickly and then soon put 11 and 12 so that my numbers don't go wrong. So then you all know which video to watch in order. Otherwise, no, these fellows, uh, no, they come and, so this is not there, that is not there. So what do I watch after this? That's why I have numbered it and I have renamed it and I have done everything as possible. So it's easy for you to find the video. So what to do? Now, right. Your brother, okay, I don't know who he is, but okay. Right, question 33, Lamai. How do we do this? Which of the following happens when the central bank reduces policy interest rate? Easy, no? Remember, I explained this. What happens, guys? When the CBSL comes and reduces their policy rates. Remember, we spoke about this also in the mock exam in the Saturday's doubt clearing session. So if they reduce policy rates, what is going to happen to the other interest rates in the market? The call money market rate, then eventually the short-term interest rates, then the long-term interest rates. What's going to happen to market interest rates? It won't happen within a day, but little by little it will get impacted. I explained how that happens on a previously. So what happens to market rates? Market rates will come down. So if the market interest rates come down, Lamai, What can you tell about the uh, money supply? Money supply. Money supply will increase. Okay. What can you tell about demand for money? Speculative motive. Now they are, because they are asking for demand for money here. What can you tell about demand for money? Remember speculative motive we have learned. What happens? When interest rates come down, demand for money, demand for money, demand for money, and go up. We'll see if this is how they are arguing this question. We'll see. We'll look at the questions and see which one can be our answer. Number one, demand for money decreases. And we are saying increase. Demand for money increases. Okay. Market rates increase. Supply of money decreases. No. Supply of money increases. Market rates decrease. Okay. Looks correct. Demand for money, supply of money, and market rates increase. No. Is both the answer? Can someone check the past paper? You can argue this in different ways. That's it. Yes. 2017. Is that okay, guys? If the central bank reduces policy interest rates, how do market interest rates go down? Okay, that's a bit of a longer story. I did explain this in the mock exam series. If you're there in that, you can watch how it works. So how it works is, guys, I'm not going into detail again. If when the government reduces or the central bank reduces policy rates, remember the standing deposit lending, standing deposit facility and standing lending, and that's the interest rate corridor. The ones who are in the mock exam series, what's the video that we did this Saturday in the doubt clearing session? I explained this in detail. So when this comes down, what happens is the average weighted call money rate will come down. Okay. How it happens, I'm not going into that detail. This will come down. So when the average weighted call money rate comes down, all the other short-term rates will come down. The short-term interest rates will come down, like overdrafts, short-term deposits, saving deposits, those will come down. When short-term rates start to come down, eventually the long-term rates will also come down. So this is the treasury bonds, long-term loans, those will come. That's how it usually works. So central bank can't come and say, go and reduce long-term loans for commercial banks. They can't do that. They will come and make the change over here. When they make the change in policy rates, little by little, other rates will also come down. So when policy rates reduce, other rates will also come down. That's what you call the market rates coming down. See? Okay, that's 33. Then we'll go into 34. Okay, this is very easy, guys. The primary goal of central bank in the conduct of monetary policy at present is, it's still the same. What is their main goal of because of the monetary policy, guys? Past paper says 1. Can someone check, guys? What does the past paper answer say? 33. 4. Okay, 4 is fine. That's what I also explained. No, because that's why I just wanted you all to check, because it can be argued a little differently also. We'll not go to that, then I'll just confuse you all now. Past paper answer says 4. My explanation is correct. Okay. 34. Primary goal of the central bank to conduct its monetary policy, guys. What's the main aim? Why do they conduct the monetary policy and all of it? For what purpose? To control inflation, no? That is the whole purpose. Remember, they change the policy rates, that affects the money supply, then the aggregate demand, then at the end, it affects price level. That is their main thing. So the primary goal, guys, of monetary policy is number 1, guys, to maintain or stabilize inflation at a mid-single digit. What is this called? 1 for 34, right? In the medium term, but there is a name for this, guys. What is this thing called? Keeping inflation at the central bank's target to keep inflation at. What is this framework? It's called what? It's called FIT. In other words, flexible inflation target. So the central bank has a goal of what? Of keeping inflation at a mid-single digit. To mid-single digit in the sense, mid means somewhere around 4 to 6%. So to keep inflation there. So to keep inflation at that level, they will use whatever monetary policy tool, policy rates, open market operations, SRR, whatever monetary policy tools, they will use that to somehow keep inflation at a mid-single digit. That is the central bank's main goal of running the monetary policy. Why can't we use the fourth one? To achieve sustainable growth. That's not the primary goal, guys. The main goal of having the monetary policy is to keep inflation at stable. If you keep inflation at a stable level, then eventually economic growth, unemployment, everything else will become stable. The main goal of the monetary policy is not to maintain economic growth. Okay. 35. Okay, again, very easy, guys. What will happen to the money supply and the equilibrium interest rate, that is the market interest rates, if the central bank sells securities in the open market? Okay, CBSL sells. CBSL sells means who is buying? Combanks buy. So Combanks buy means what happens to the reserves in the commercial banks? Now commercial banks are spending money and they are buying. So reserves in the commercial banks, now they have to buy. No, central bank is saying, come buy this for me. So then reserves will go down. Reserves go down, what will happen to the ability to give loans? Ability to give loans go down. Ability to give loans go down, what will happen to money supply, Lamai? Money supply goes down. So that is number one. So now think, when there is low reserves, low money supply, on the other side, what can happen to interest rates? Now there's very little money in the market, right? Central bank has sold and taken all the money and gone. Interest rates. Now, interest rates on the other side will start to rise. There is your answer. And you see the same question, no? Product they change. So sometimes they say central bank purchase, sometimes they say central bank sell, sometimes they ask what will happen to money supply, sometimes they ask what will happen to something else. So this story you need to have in mind. So what's the answer? Money supply comes down, interest rate goes up. Number 2. Okay. Is that fine? 35? Right, that's it. How did you all do so far? There were 8 questions. 1, 2, 3, 4, 5, 6, 7. Yeah, there were 8 questions. At least 5 or 6. You all should feel the questions getting easier, right? Maybe since you did it before, so you got it wrong, but you should feel the questions getting easier now. The pattern is the same, same thing, right? That has to be there. That's the whole objective of doing the papers, right? So then we'll go into the next.